thank you everyone for joining in this call and welcome to another episode of our Fund Manager series. Today we have Mr. Krishna Singhvi. He's the Chief Investment Officer Equity at Mahindra Manulife Mutual Fund. He's a CMA from Institute of Cost and Works Accountants of India and has also done MMS in Finance. He has more than 27 years of work experience, of which 14 years have been in the mutual fund industry and around 8 years in the life insurance industry. He was earlier associated with Canara Robeco Mutual Fund, Kotak Mahindra Mutual Fund, and Aviva Life Insurance Company as head of equities. In these roles, he was responsible for managing and overseeing equity portfolios. Thank you, Krishna sir, for joining in today's call and addressing our audience.
Thanks, Aditya. Thanks for having us, and hope it's a good, interaction for both of us and our customers.
Right, sir. So my first question is on your AMC. Mahindra Manulife is a relatively new fund management house, and the industry has been dominated by large banks, bank promoted names. So can you throw some light on your fund house and your inception and some of the best practices that are deployed at your fund house?
Yeah, so Mahindra Manulife, as a firm, we basically started in 2016, July 2016 to be precise. The first scheme was launched. Originally, we were Mahindra Mutual Fund, where Mahindra Finance was holding 100% share capital of the company. In May 2020, it actually became a joint venture where Manulife, which is the life insurance company with headquarters in Canada, took 49% stake. So it actually became a 51-49 joint venture between Mahindra Group as such and Manulife. And it's now more than 4 years of the joint venture. So effectively, yes, we are an 8-year-old firm in terms of our vintage, and looking to manage money for our clients in a way where we can contribute to their wealth creation is a thought process. From an investment perspective, on equity side, essentially, we follow GCMV as an investment framework for evaluating companies, deciding what sort of companies are more suited for our portfolios, etc. So GCMV, the word acronym basically stands for growth, cash flow, management, and valuation. So 4 variables is what we generally track, saying that is this company in a growth industry or not? Where the growth can come in? Is it a growth led by more of volumes, growth led more by premiumization of its products, more led by pricing power it has, etc., etc. Even partly, it can come from cost reduction potential, etc. Second important part in our industry really is the cash flow. Pure growth without supporting cash flow need not really help to create value. So that is the next stage we look at. Is this growth, cash flow accretive? Does the cash flow have a potential to be redeployed in the business for a much higher, ROE profile, etc. Third ingredient of, investment framework really is the management quality, our understanding of management in terms of their past track record of execution, past track record of corporate governance, and investor friendly policies which they would have demonstrated. So that's the most important in a way, management quality, because they are the one going to lead the business on a daily basis to run their basic business for the growth of everybody else. Fourth part is valuation, and valuation is something very interesting in the sense that valuations is relatively difficult to explain, and were most important to understand, because in markets, we do have this nice understanding that wealth is created in markets over two variables. One is how companies inherently grow, create their own earning growth potential, and second is how markets start appreciating them. Temporary exuberance or lack of exuberance or extreme negativity on a companies, those creates opportunities to buy companies in terms of undervalued or possibly reduce your weights or get out on a overvaluation mode. So this four framework is what we look at, and our understanding really is that while India is essentially a growth economy, growth country, simply too many sectors, too many companies in India are operating on a growth journey. So on an average, high probability that everybody is going to grow. The pace of growth can vary. Some sectors may lead, some companies may lead, some others may lag, and that's one is to understand that interconnect between the economy on both sides. Lead sectors, laggard sectors, but at the same time, laggard sectors do grow. They do their own earning growth. They have their own, equity market appreciation or valuation correction, etc. So our understanding is that based on this GCMB framework, if we are able to analyze a company which having a current market price as one variable and our understanding of fair valuation as a second, if the gap is in our favor, which says that we believe the price should be reasonably higher than what it is right now trading, we would like to believe that let's try to identify is there any reason why this uh, price convergence can happen, and we call it catalyst, saying that is there a catalyst which can bring the our understanding of the equity uh, valuation of this company basically being met by markets appreciating the same, and if that catalyst is visible over next 12 18 months, that's ideally the sweet spot, because in that journey you make both money by way of market multiples being re-rated as well as some sort of earning growth visibility coming in. Yeah, so that's broadly I think the way we look at markets and equity investments at Mahindra Manulife.
Thank you so much, sir, for very comprehensively explaining your investment process. And since you told about valuation and it's the most difficult thing to figure out, my next question is on the valuation, and it's been a talking point. We have seen a tremendous rally in the market over the last 1.5 years, and particularly in mid and small caps. The last 1 year, 1.5 years performance has been exceptional. And particularly in this month, we saw some downside volatility. And you manage more than 8,500 crores across your mid and small cap funds. How are you looking at the valuations in this space? What are the earnings growth estimates you are looking for mid and small cap indices and for your portfolio?
And
And particularly for investors entering for the first time, does SIP, STBs are better options to allocate money in mid and small caps?
yeah, I think let's take the last part maybe as a first. I think for any investors who are looking to create wealth, Indian economy is on a growth path. Okay, let's not make a mistake there in terms of economy is on a growth path. We are currently around, let's say, $4 trillion economy today, likely to be 6, 7, 8, 10, depending on how many years you want to forecast in future, and some sort of estimate of the world around us makes us believe that yeah, we are more likely to go to this journey of 6, 7, $8 trillion, and you realize that what markets have done in terms of creating wealth in the initial journey of wealth of this market uh, economic market cycle of India, where we possibly were less than $1 trillion economy somewhere in 2006. So if for any investor who's possibly new, I think the first thing they need to understand is that as long as the economy keeps on, doing well, equity markets are more or less likely to respond to the economy by creating wealth. Now, this wealth is something which gets created in a way slightly disproportionate uh, to the earnings at times. Those disproportionate times are on both sides. Sometimes, markets appreciate far more ahead of the near-term reality. Sometimes markets are not able to understand the near-term reality, and that's why they falter behind. And those opportunities possibly give us a time to really, review our own asset allocation, etc. So, what you said in a way about last 1.5 year journey of India small cap, mid cap, possibly I can extend to even maybe 15 years or 20 years, because that's been the case, right? In all our journey, we've actually seen Indian equity markets having delivered returns where on an average, uh, small cap, mid cap, and even large cap have delivered good returns, mid-teens kind of range. Actual numbers will vary at depending on what frequency you want to compute, at what interval you decide to have your cutoffs. But the reality is that economy is done well. There is a two ways to look at mid and small cap. One is mid and small cap companies are essentially those companies which are participating in the growth economy by way being either a producer or a consumer of what a large cap company does. There are many industries where they are smaller in size, and that's the reason they become mid cap or small cap, because the absolute market cap, as defined in India right now, is the top 100 companies are large cap, the next 150 are mid cap, and the remaining, let's say, are small cap. But yes, those growth journeys are in place. Valuation wise, clearly, markets are not likely to give a proportionate, upside. So if there is a 13% earning CAGR, you are not going to have exact 13% returns on market. Sometimes it becomes 23, sometimes it becomes 5, sometimes it becomes 25, sometimes 10. I think those ranges are in place, and what we have to appreciate is that yes, in this overall journey of equity markets, there will be times when we do have a little bit more euphoria stroke positive, view on the economy, and but that's the time it's supported by liquidity. So if liquidity is something which is creating a more buyers at a point of time vis-a-vis more sellers, you will have some much sharper, returns profile in equity markets, which is what we've seen, especially in last 18 months, let's say, where mid cap and small cap as a space possibly attracted more money. So that's the liquidity side. Economy side, I did mention that this mid and small as a category has anyway delivered over last maybe 20 years also. If you see point to point, if you look at rolling returns, also is same. So broad idea is yes, mid and small companies are here to participate in the growth of the Indian economy. Sometimes the equity markets may lead to some sort of euphoric valuation or some sort of underwhelming valuation, and that's what our role is. Maybe for now it looks like uh, large caps offer more attractive risk reward equation, more better value proposition if you're looking from if you're a fund manager eye for next, let's say, 6-12 months period. But if you look at it a little bit from an investor side who's possibly not fully invested in markets or under invested in mid and small, I think moment they increase their horizon to 3 and 5 years journey, possibly they still can look at small cap, mid cap as also a relevant part of the portfolio. But yeah, near term valuations clearly favor the large caps.
Correct, correct. Thank you so much, sir, for this explanation and beautifully taking us through the uh, market cycles that we have seen over the last 1.5 years. You are also directly managing more than 1,800 crores in your focused fund.
Yeah.
And the fund has done relatively very good when we compare it with the peers as well as the benchmark. Uh, and then there are so many categories in mutual funds. So can you explain to our audience what is a focused fund and how it is different from a broad-based? And what are the key risk and return associated with this particular category?
Yeah, so the focused fund, essentially, maybe as the name suggests, is slightly more focused on few names in the portfolio as a part of stocks held or the companies invested in. Focus fund as a category is defined under regulations where we basically cannot own more than 30 companies in the portfolio at any point of time. So that's where the focus comes in, saying that the fund manager is expected to own not more than 30 stocks at any point of time, and hopefully because of a slightly narrow range of what the fund manager can own, uh, it's like he or she has to really apply far more focus on stock selection and portfolio construct that way. So for Mahindra Manulife, focus equity fund, essentially you write something like 800 crores equity AUM. We would be completing 4 years next month, and so that's a nice journey for the fund. 1,800 odd crores AUM. The intent is clearly to say, can this fund have a nice blend of large cap, mid cap, small cap stocks across categories of sectors, stocks. In a way, this fund, will be slightly more forced to take higher conviction calls because you will not be able to participate in almost every sector or quite a few themes in the market. So you'll be forced to choose what is likely to do better uh, in your near-term time frame. Maybe as I mentioned, 12 to 18 months is generally we would like to focus on in this fund. By nature, it's a flexi cap fund in terms of market cap requirements. So we can own anything between large cap, mid cap, small cap. Traditionally, this fund has been run more with a little bit of a large cap bias over last 4 years. And I do expect, that considering this 30 stock and the ease of, portfolio transition, etc., one would possibly have a little bit, large cap flavor in terms of relative weight of large cap will be more. Currently, how we're running is that we generally like to, reduce exposure to small caps at 2.5% of the fund in terms of the point of purchase, because we do believe that 2.5% is a nice fit to own in a slightly more concentrated approach on a small cap. So to that extent, yeah, we'll have some large cap, mid cap, small cap blend. Marginal changes may happen. It's actually not going to be driven more by market cap view. It's more going to be driven by company selection out there.
Correct, correct. And so a lot of people ask us about the difference between mutual funds and PMS. And as standard, the major difference that we see is mutual funds are more diversified approach, PMS are more focused approach. But
Hmm.
if you are taking a focused mutual fund, then you are getting a focused portfolio of less than 30 stocks.
Yes.
And particularly the probability of both outperforming and underperforming increases in this kind of category. Uh, Sir, we also very rarely recommend any sector-specific funds to our investors because we believe fund managers are in a better position to rotate the sectors. And we have also seen majority of the sector funds have underperformed the broader indices in long term. Also, sector and rotation at investor level becomes very tax inefficient as well. So, what are your views on the same, and which are the key sectors where you are currently overweight or underweight in your portfolio?
So no, you're right. At times, sectors, as I mentioned earlier, some sectors lead the economy stroke wealth creation. Some sectors lag over a period of time. Some of these things do get ironed out or adjustments are happening, but yeah, over in a particular time frame, you can clearly have few sectors of the economy doing well, equity markets appreciating those sectors as a winner, while some other sectors which are not doing so well typically get impacted in terms of either negative returns or reasonable underperformance in the market. uh, some of these things can be taken care by two active approach. One approach is, yes, you actually invest in those sectoral funds and do active asset allocation as a wealth manager, as an investor, saying that okay, for the time being I like a particular theme, particular sector, and I invest there in some funds. At some point of time, after having made my returns, etc., can I shift to some other sectors? And again, you said clearly, tax efficiency is a challenge there because you will have to pay capital gains tax as applicable. Another option really is have a look at a product category called business cycle. Now, business cycle, by definition, is saying that the fund house, the fund manager would possibly take the role of shifting multiple sectors within the role, where the idea is simple. As all sectors have their own lead and lag timings, can fund manager keep on trying to create a portfolio with a similar outcome expectations and in a reasonably good tax efficient manner, because when such things are uh, churn activities are done at customer level across funds, there might be tax implication, but when it's done in the same fund by the fund manager, you are not going to have a tax implication as such, because the portfolio management is actually at the client at the fund level. So that's the idea. Maybe business cycle fund can play out. Coming to your idea about sectors, see the way the markets are poised right now. You have a nice combination of some sectors where the earning growth is pretty good, pretty visible. At the same time, the some sectors having some challenge of valuation. So little bit interesting to figure out right now. Maybe it's time for less of sectoral calls, more of stock specific actions. Because yes, you do have a space where let's say for example, power looks quite an interesting opportunity maybe for next 3, 5, 7 years of growth. Or maybe a little bit like metals is interesting. Capital goods, in a way, visibility is good, but possibly valuations are a little bit, I'll say a premium vis-a-vis what we are used to see. There are some sectors attractive, but unfortunately, the valuation multiples, possibly are not so attractive. So it's a challenge in terms of looking at markets right now. The better answer possibly should be let's look at stock specific within a sector, and that might open more opportunities as such. But yeah, core theme of India remains one is consumers, one is financials, one is your industrial infra, and other is the or the global market, which is maybe IT pharma kind of thing.
Correct, correct. And particularly in the last 1.5 years, people, whatever you pick, it has gone, it has worked out well for investors. But now I believe it would be the market for stock pickers, and good active fund managers would do well in this in this kind of market. And sir, similarly, on the tax efficiency side, our belief is that mutual fund is the most efficient, tax efficient way of investing.
Yeah.
Do you think is it better than taking direct exposure in stocks from the tax efficiency perspective? Because whatever churn that the mutual fund manager is doing, if he's rotating the sectors or if he's rotating the stocks, it is not getting taxed at the hands of investors. Only when the investors redeem the funds, then it gets taxed. But if you're managing a direct portfolio of stocks in your own account, and whatever churn rebalancing that you're doing within 6 months, 12 months, you have to incur those tax liabilities, be it short term or long term. So, do you believe that MF, since it's a pass-through structure, it's one of the most efficient, tax efficient way of investing into markets?
Aditya, well, definitely tax efficiency can be one reason, but I'll possibly highlight slightly more important and possibly number one reason. And for it should be the time and knowledge availability at the point of investor. Moment
Correct,
an investor wants to manage money on their own, the kind of time commitment is required, kind of maybe discipline, kind of knowledge. Etc. Is far different. I'll say investors should worry about that as much as I think tax honestly is an outcome of profit. So if you go finally going to make money, nobody will mind not paying tax.
correct,
But I think
correct,
the bigger challenge for investors is going to be how much time, because many of them are busy with their own basic economic activity, which is either a business or employment somewhere else. So their ability uh, to invest cannot be simply based on what they see on a market screen every day. It has to have some sort of knowledge, some sort of a research based decision making process with conviction, etc., built over time. So I think my sense is yes, while tax can be a variable which people need to be worried about, I think the bigger one should be the time and knowledge available for making direct decisions.
correct, correct. And sir, as wealth managers, we always look at the time horizon when recommending funds or portfolios to our clients. But what is the usual time horizon you look at in your funds when you're picking any particular stock in your portfolio? And what is the typical churn rate of your portfolios?
Sure. So I think as a fund house, Mahindra Manulife has taken this thought process of active fund management, because that's where your ability to to participate in the various lead lag sectors of the economy and market cycle can be taken role of. What we really believe is that uh, while everything is good in the long term, those lead lag phases, create these opportunities. To our mind, that 12-month, 18-month is a nice time frame where it not only allows for some sort of a change in earning profile to be captured, to be reflected in the earning side of the company, as well as for markets to really appreciate the new earning profile and go for a multiple re-rating, etc. on that time frame. So to our mind, yes, 12 to 18 months is a nice time frame to select at the point of investment. This does not really mean that we actually will sell at the end of 18 months exit, or the idea is just when you investing your money in a particular company, your ideal time frame should be in this range. One should not really today invest for that in 3, 5, 7 years, because longer the time frame, I'm sure there'll be enough data points you will get, enough milestones you can get to really buy possibly at a later date. Because more longer you want to put yourself, you will have to settle for a earning which is back ended. Shorter the
Correct.
time frame of 12 month, 18 month, your measurables are much quicker, your milestones are visible. And so our idea is, with the focus on earning change, etc., multiples to reflect those changes. Yeah, 12, 18 months is what we look at. Now, if I convert, this 12, 18 months into your other question about, portfolio turnover, which, a fund manager does as a part of their active fund management style. Typically, 12, 18 months kind of time frame in a way conveys, something between a 65% to 100% kind of portfolio turn, which you may like to be aware of, that if the time frame is 12 to 18 months at the point of investing, fair to expect, this kind of range of, portfolio turnover, and yeah, hopefully those other factors remaining same about investment time frame, catalyst, maybe tax efficiency, they should play out, yes.
Sure, sure. And so we hear a lot about liquidity in the market. It's very high. Domestic liquidity is very strong. If you can help the audience understand what role does liquidity play in markets and who have been the major suppliers of liquidity in recent times, and your assessment on the current market volatility.
So, so liquidity actually comes, from multiple fronts. So one front really is that basically as the economy grows, economy creates its own, higher nominal income. So if you are a, let's say, 300 lakh crore economy and growing at a 10, 11% nominal, the economy as a whole itself, creates something like 30, 35 lakh crores worth of fresh money to be, generated in the economy, and by default it goes to various participants, whether it's households, whether it's corporates, whether it's government, etc. So when money goes to the hands of people, it contributes, to their own potential saving, and by default they decide to invest money for growth. And yeah, for growth market, maybe equity markets are perhaps, one of the most attractive, opportunity to invest money. So this money actually finds their way into markets by way of investment into equities, via mutual fund or equities, maybe in a direct way. So that liquidity, which is in a way the function of growing economy, is first contributor. Second part of liquidity really is that investors would like to compare alternate rate of returns between various products. So maybe between fixed income, maybe between real estate, gold, etc., which are the traditional ways of investing. People do they have their own understanding of uh, what incremental return profile can be of these various asset classes, and that's the second liquidity, which means it's an alternate. People would possibly like to move away from an existing asset class into equity as asset class, and that liquidity comes in. And the last part of liquidity within this, space is just people would like to buy or invest in either a large cap or a mid cap or a small cap or a few sectors at times. So this is, what the broad picture of liquidity is. Maybe if I have to add one more variable, it's unfortunately not so positive for last 1 month, but yeah, the other variable is FII liquidity. The way there are Indian investors looking to invest in Indian equity markets, there are global investors who looking to invest into Indian markets. So those all factors contribute, to give investment. So if I had to give you a color, uh, our broad equity market, market cap in India is slightly over 400 lakh crores. Maybe
Correct.
that nearly $5 trillion, about the number sometime last week or 10 days back. Now, against this, if I do the current run rate of what mutual fund industry is possibly getting, we are more or less at 35,000 odd crores per month, assuming that run rate is annualized. You're talking about something like 4 lakh crore, which is approximately 1% of the market cap. So that's nice liquidity where there is fresh money coming to invest in the market, and that possibly helps. Yeah, some segments of market can get slightly more flows, and by default, some sort of overvaluation based on the capacity of those segments to attract money. So if more money goes into small cap or mid cap, maybe yeah, the pockets of valuations might increase. On the liquidity side, I'll give you the other side of liquidity, which is actually the liquidity from the company side, from the share supply side. So earlier liquidity was all the demand side, where investors want to participate. Now let's come to the company side. Companies really want to raise equity market capital from equity markets to further future growth, or existing promoters want to sell. So that liquidity also is something we need to be aware of. Okay, what yeah, in a way, it's a negative liquidity, but yeah, net those forces of demand from investors and supply from existing investors or companies possibly create this nice mix and match between demand supply curve for markets.
Correct, correct. And so we also believe that there should be a good supply of companies that should come into listed capital markets because, um, and we have seen good domestic flows, no more than 20,000 crore of SIP book, but that should also match with the supply
Yeah, yeah.
from the primary
No,
market.
that clearly helps because first of all, investors get an
Correct,
opportunity to invest in a new segment, right? If unlisted companies versus listed companies, you clearly get an opportunity to invest and participate in
correct.
their incremental growth journey. So that clearly helps. Even markets mature, it possibly creates a space where overvaluation of some other sectors gets moderated because some new sector gets or new company gets added to the investable universe.
Absolutely. And sir, when we look at definitely there can be arguments whether the valuations or are stretched. But when we look at the macro parameters for the country appears to be very stable and very good. Uh, how are you looking at the macroeconomic situation and the interest rate situation in the country? And how does the global market affect the interest rates in India?
Sure. So let's look at the economy. Let's say two legs of economy. One is pure play domestic. We're doing reasonably good. Another leg really is the external economy where India is connected with the world by way of being an exporter to the lot of global economies. I think that economic the export phase is a little bit weak right now because globally the growth rates are not so attractive. So to that extent, any country which is consuming or importing goods from India possibly has its own challenge. So little bit headwind on that front is there. From a domestic economy, uh, reasonably good. Maybe last year was slightly higher growth rate at 8.2%. So partly this current year looks to settle more like 7%, or even RBI has put a number of 7.2, while some other agencies are looking at somewhere close to 7. But even at 7%, the growth is good. It is something where a little bit more support can come in once the rate cycle in India possibly reverses, where a rate cut can contribute to growth. How global rate cycle supports Indian economy is something very similar again. Global corporates have the option of investing into India by using their money abroad, and that money, if it's a lower cost, it improves their ability to invest. Their threshold for profitability break evens to improve. So to that extent, yes, that's the global connect. Our economy is broadly doing good. Maybe consumption is right now taken a little bit of a backseat vis-a-vis what historically we've been used to. But that's the space where equally interesting outcome is that as this manufacturing picks up, as some sort of a support system from various government initiatives takes into place, the consumption does pick up, and you back to slightly better growth rates on consumption also.
Yeah. Thank you so much, sir. And thank you so much for joining in today and taking out time for addressing us and our audience. I thoroughly enjoyed the session, and we look forward to doing these sessions with you and your AMC in future as well.
Yeah, sure, Aditya. Thanks, and I think best wishes to all your investors and your team. And yeah, happy Diwali. Maybe a couple of days in advance, but it's a
Yes,
festival, so we all need to
correct, correct.
enjoy that. Yeah.
Thank you so much, sir, and wish you a happy Diwali as well, and happy Diwali to all our viewers as well.